Yeah, I think the key things to consider with fixed rates right now is, are you expecting any changes in your position? That might be, are you thinking there's going to be changes to your income in the foreseeable future? Are you expecting any additional funds? So whether that might be bonuses, commissions, and cash injections. If you are expecting changes to your position, or whether you're looking at selling maybe, you probably want to lean more towards the short-term fixed interest rates. The good news is these rates are the cheapest interest rates right now. They're sort of sitting in the sort of mid to low-ish 4% range right now. If you are not expecting too much change in your position, you're feeling pretty comfortable with where rates are at, the short to medium term is probably the sweet spot for you. I'm seeing a lot of people leaning towards the 2-year fixed term. We've got a lot of volatility at the moment. Donald Trump, I think I don't really need to say anything more other than his name, is causing some chaos, and there is a lot happening in the world, which is having an impact on our inflation in New Zealand and therefore our economy. So in the short term, we are likely going to see more change or more volatility in our rates, and unfortunately probably some more rises. We may see 2 more increases to the OCR by the end of this year. I think, that would mean we could end up with interest rates close to 6%. But I don't think we're going to see those rates we saw post-COVID hitting the high 6s, 7% space, which means I think those sort of short to medium term rates do offer some pretty good balance for you. It gives you longer, or gives you more certainty than 12 or 18 months, as we do see that volatility in rates and probably those main changes, but it doesn't lock you in too long, so that you can still take advantage of what is right now quite a strong interest rate, with most banks sort of 4.99 to 5.09% roughly. Without locking too long into the future if you do have changes coming. If you have maybe an investment property, or maybe you've got one income at the moment, or you've got a situation where you're like, I just really, really need or want some certainty, then you could look at fixing things a little bit longer. The 3-year rate is still reasonably competitive, sort of sitting at about 5.29 to 5.39% with the major banks. So it's not that much higher, but those repayments in the short term are going to be a bit higher, but it's going to lock you into that rate, so you know exactly what's coming for a period of time. If you are going to, after 12 months, go, oh, rates have dropped, I wish I was on a lower rate, we all have those moments. I think that the sort of making sure you've got a balance can be quite good. So that might be a position where you sort of think about splitting your lending into a couple of portions. And the 4 and 5 year rates, they're sitting a bit higher. Definitely need more certainty for those ones, probably mostly for investors. If I'm honest, there's not a lot of scenarios at the moment where I think that offers great value. It's very much depending on your scenario. We're seeing more and more people split their lending into different portions, particularly when it comes to reviewing some shorter term to make lump sums or change repayments or things like that. Overall, have a chat.